We're jumping straight into Applied Digital today. And look, we have to look beyond just the price swings.
Yeah, that's just noise right now.
Everyone is focused on where the stock is trading, but the real story, the fundamental shift happening, is this asymmetry.
Between valuation and contracts, that's the whole game right here.
Exactly.
The company is actively moving from being this construction phase business, which, the market just prices like a super high risk, speculative AI trade.
Right.
And it's becoming a fully operational, contracted, and this is the key verifiable revenue generating engine.
And the numbers that define that gap are they're staggering. On one side, you've got, roughly $6.7 billion in market value?
Right, but the market says it's worth today.
And on the other side, $16 billion in contracted revenue backlog.
Yeah.
Just think about that disconnect for a second.
It's massive.
The entire market is just holding its breath for this one trigger, that January 7th earnings report, because that's the moment all this massive operational capacity finally shows up tangibly on the income statement for the first time.
Absolutely. And you're tuned in for this analysis where we help you understand the core mechanics and the catalysts that are driving transitions just like this one. We are here to help you get well-informed and fast. I'm glad you're with us.
If you're finding value in this breakdown, please make sure to subscribe and hit that like button. It really, truly helps us bring these discussions to you. And definitely let us know in the comments which company you want us to simplify next.
All right, let's dig in. We need to look at the powerful bull and bear cases for Applied Digital. And honestly, the best place to start is just the financial trajectory. It's accelerating.
Okay, so lay out that bullish revenue path for us. How fast are we talking here once these facilities are actually, fully online?
The shift is pretty dramatic. If you look at the projections, fiscal 2026 revenue is expected to land somewhere between $280 and $297 million.
Which is solid growth.
It's a strong 30 to 38% growth year over year. But you need to hold on to that number because the real story is fiscal 2027.
Okay.
The estimates just explode to 541 to 553 million. That's an estimated 86 to 93% growth rate.
Yes. That kind of hypergrowth, though, it usually screams risk. The market's full of companies projecting that kind of thing, only to see demand just fizzle out.
Right, or competition undercuts them.
Right.
But that's where the power of this business model really shows itself.
So it's not speculative.
No. That projected growth is underpinned by that massive $16 billion contracted backlog we mentioned.
$16 billion.
This isn't hopeful future revenue. This is business that is already locked up, signed, secured. It gives them 15 years of deep revenue visibility.
Okay, and help us understand the quality of those contracts. A 15-year contract is only as good as the company signing it.
That is a massive point, and it's critical here. These aren't agreements with startups. These are 15-year lease agreements signed with what we call investment-grade hyperscalers.
So we're talking about the big players.
We are talking about the backbone of AI infrastructure, Microsoft, Amazon, Meta. When you secure long-term revenue with those kinds of balance sheets, you drastically mitigate counterparty risk. The demand isn't just secured, it's secured with the world's most financially robust companies.
Okay, so the revenue is coming, and it's accelerating. But if you look at their bottom line right now, the earnings per share, it's negative, projected negative 80 cents in fiscal 2025.
Yep.
For someone who's new to this kind of infrastructure play, how do we reconcile that? Massive growth, but current losses.
That negative EPS can definitely scare off investors who are just looking at traditional earnings metrics. But you have to understand the accounting dynamics here. This loss is a temporary accounting artifact.
An artifact of what?
Of the construction phase. Imagine you're building a massive state-of-the-art factory. You have to spend billions on land, equipment, labor, and all those costs hit the books immediately.
Right, before you've made a single dollar.
You carry that loss until the factory is operational and starts collecting revenue.
It's the ultimate front-loaded investment. You pay the tuition up front before you start getting the diploma.
Precisely. The expense is hitting way before the revenue engine turns over. But the path to profitability is exceptionally clear. They expect a transition to positive EPS of about 15 cents projected for fiscal 2027.
And that's the inflection point.
It's a crucial inflection point where operational revenue finally overtakes all those financing and construction costs. And if you look further out, the operating leverage in these facilities suggests they could scale to $500 million. Or even $1 billion in annual net operating income.
NOI.
NOI within the next 5 years.
Wait, hold on a second. For our listeners who might not be familiar with that term, what exactly is NOI and why is that metric so important for data centers?
That's a great question. Net operating income, or NOI.
Yeah.
It basically measures the profitability of the asset itself before you factor in things like interest or taxes.
So it's the pure cash generating power of the building.
Exactly. For a data center, it's the lease revenue minus the operating expenses, electricity, maintenance. When we talk about scaling to a billion in NOI, we're talking about the raw cash flow power of these physical assets. It shows that once they're running, they are just enormous cash generators.
That's an impressive scale. But if the opportunity is so clear and the demand is so certain, what stops a competitor? Why can't Google or someone just replicate this? Build their own campus next door in North Dakota.
And that brings us to the moat, the multi-layered moat, the structural advantages that are just really hard to copy.
Okay, what are they?
Applied Digital has two distinct edges. The first one is technological. They're a proprietary liquid cooling solution.
Tell us why cooling is such a big deal, especially for AI.
AI workloads.
Yeah.
Training these large language models, running complex simulations, they generate an unprecedented amount of heat. Just enormous.
And traditional air conditioning can't keep up?
It just can't handle the heat density.
Yeah.
Applied Digital's liquid cooling tech handles these high-performance compute workloads up to 3,000 times more efficiently than traditional air cooling.
3,000 times. That number sounds almost unreal. Put that in practical terms. What does that efficiency actually mean for a company like Microsoft?
It means two critical things for their bottom line. First, density. With liquid cooling, you can pack way more computing power, more GPUs into the same physical space.
Ah, so you get more bang for your buck on the real estate.
Exponentially more. And second, and maybe even more critical, is the reduction in wasted energy. It's measured by something called PUE, or power usage effectiveness.
Lower is better.
Much better. Liquid cooling drastically lowers that PUE score, so less power is wasted on cooling and more is available for the actual computing. That gives them a permanent built-in cost advantage for their customers.
And that explains why they'd sign a 15-year contract. Okay, what's the second moat?
The second moat is geographic, and it all comes down to the ultimate scarcity in the data center world.
Power. Right.
Applied Digital has secured gigawatt-scale low-cost power allocations in North Dakota. Power is the single biggest constraint on data center expansion globally right now. You just can't find cheap, reliable grid capacity anywhere.
And they locked it down early.
They did, and that gives them a serious, difficult-to-replicate barrier to entry.
Okay, so they have the demand, they have the tech, they have the cheap power, all massive advantages. But building this stuff is incredibly expensive. We talked about capital risk being mitigated. How is the funding actually secure?
The capital risk is essentially de-risked. This is a huge indicator of institutional conviction. They secured financing from groups like Macquarie,
A huge name in infrastructure.
a global leader, and they received NVIDIA capital commitments. When institutional players and strategic partners like NVIDIA, who know this hardware better than anyone, commit that much capital, it's a massive vote of confidence, not just in the idea, but in their ability to actually build it.
That backing changes the entire risk profile.
Okay, let's pivot to the immediate action points. The stock's been on a tear, a massive 237% return in 2025. Where should we focus our attention in the next few weeks?
Everything comes down to one single date, the Q2 fiscal 2026 earnings report on January 7th, 2026.
That's the catalyst.
That is the critical near-term catalyst. Up to now, the whole bull thesis has been based on projections, on contract signings. This report is the moment the operational RAND has to clearly, tangibly validate all those claims on the income statement. The market is waiting for that hard proof.
And alongside that earnings report, there's another move to unlock value, the Chronoscale spinoff. What's the thinking there? So the spinoff merges their cloud computing business with another entity to form Chronoscale. Applied Digital keeps a controlling 97% ownership.
And the motivation.
Pure value creation. The cloud GPU business is high growth, but it operates differently than the core data center leasing business. By spinning it off, analysts believe it allows that high-growth arm to scale faster on its own and potentially get a higher valuation multiple.
And it lets the parent company, Applied Digital, just sharpen its focus on its core job, building and running these specialized data centers. It clarifies the whole story for the market.
Exactly. And this brings us right back to that massive valuation disconnect we started with. If the company is this de-risked, with $16 billion in secured revenue, Why is the market cap still sitting around 6.7 billion?
That is the crucial paradox. 6.7 billion in market value versus 16 billion in contractual revenue visibility for 15 years. It seems fundamentally mispriced.
It does. The market is still pricing Applied Digital like it's a speculation, like the company might fail to finish the build-out or the customers might somehow walk away. It's not pricing it like an operationally de-risked infrastructure business with its revenue pipeline locked for a decade and a half.
And that disconnect is where the potential upside is.
That's why the upside is seen as asymmetric. The fundamentals are just waiting for the operational evidence to catch up.
Before we hit the risks, what about the technical setup? For people watching the charts, where's the accumulation?
Key support levels have formed recently near that $24 to $25 range. The pattern of recovery we saw suggests that institutional money is accumulating on those dips.
So buyers see that as a good entry point ahead of the earnings call?
It looks like they're betting on a positive operational announcement on January 7th.
All right, we have to balance the view. No high-growth company is risk-free, especially one that's run this hard. What are the two biggest concerns right now? The bear case.
Number one risk is still execution risk. Plain and simple. Applied Digital is running one of the largest, most complex data center build-outs in history. These are enormous projects.
What does that risk look like in practice? What could go wrong?
It looks like delays. A delay in getting a key transformer, a lag in regulatory approval for the power connection, unexpected problems deploying the liquid cooling, any of that could push the revenue inflection point out.
Past that key January 7th report.
Exactly. And that would really disappoint a market that has built up some very high expectations around the timing.
But you mentioned mitigation. How are they addressing that timing risk?
It's mitigated in a few ways. First, the revenue isn't lost, it's just delayed. Those 15-year leases mean the revenue is still secured.
Yeah.
Second, the financing from Macquarie and NVIDIA gives them the capital to manage unexpected costs. And third, management has a pretty consistent track record of delivering prior phases of these campuses on time. The risk is managed, but it's still the main swing factor.
And what's the second major risk?
Valuation sensitivity. The stock trades at an elevated multiple, around 30 times sales. While the contracted revenue justifies a premium, if the broader market appetite for AI infrastructure just wanes.
Say a correction in the NASDAQ queue or something.
Yeah, general economic uncertainty. This stock could correct sharply just based on sentiment, regardless of its own fundamentals.
So even with the tangible contracts, it's still riding the AI wave, and if that wave breaks, they'll feel it.
Precisely. Though, like we said, that discount,
Yeah.
the 6.7 billion market cap versus 16 billion in contracts, provides a bit of a floor that helps price some of that general market risk in. It's a compelling contrast.
And we should probably mention the minor operational concerns, some local issues in North Dakota.
Yeah, there have been some local concerns about increased truck traffic and infrastructure strain during the intense construction. The company is actively working with local authorities on that, but these are small, localized issues. They're extremely unlikely to impact the core financial thesis here.
Okay, so to synthesize the bullish thesis, you've got a high conviction setup. It's because of the massive contracted $16 billion backlog. You've got funded execution from strategic partners and these very near-term, very tangible catalysts like the January earnings and the chronoscale value unlock.
The fundamental question for you, the learner, it all boils down to confidence and execution. Will the market keep treating this business like a construction startup, pricing it on fear and speculation? Or will that January 7th earnings report, that moment of operational proof, force the market to finally price this stock based on its tangible, contracted $16 billion revenue visibility?
That's the leverage point.
That transition from speculation to operation, that's the leverage point over the coming weeks and months.
That's the analysis on Applied Digital for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.